Okay, I'll just check that you guys can hear all right. You okay here for sound? I've got a nod there. What about you guys at the back? You okay? Good. You guys okay for sound? And presume you guys in the middle are okay? Good. Good, good. What is it time? I think it's time. Okay, just want to, sort of one administrative thing is that next week is, well, it's not really mid-semester, but the test. So I thought I'd draw attention to the fact that on Learn here, if you go into the very top section of Learn and you scroll down a bit, you get to this section here on past tests and model answers. So there's a bunch of papers, blank test papers from the past, all the way back to 2012. So you can actually practice with those ones. And then in addition to that, there's, like for each one, let's go to the most recent one down here. There's your mid-semester paper from last year, and so that's just exactly what the paper was like. Had the question blank paper, and you can work it. And then there's a second one there, which has answers and feedback on the tests. So I know some people have found these already and are using them. Well, I think they're using them, but they're there, for you to make use of as you see fit. I mean, they're not compulsory. You can use none at all, or one, or all of them as you find useful. But the test is a little bit later this year because we've got 201 and 203 running the same semester. So I've put R1 back just a little bit. But in terms of material, it covers up till the end of this particular topic. So the structure of the interest rate, which will start today and finish it on Wednesday, that will be the last topic that will be in the test, and the test is, of course, the following Thursday. So there is a gap. Because at that point, once we finish the structure of interest rates, then we move into sort of like the middle third of the course on the markets, and makes a nice break at that point to have a test, which is sort of required by the administrators for us to do. Any questions on that before we actually start the topic for the day? Okay, everybody happy? Good, good. Okay, so today we start the topic of the structure of interest rates, and this should take us 3 lectures, so it should take us today and tomorrow, and we should finish this on Wednesday. So when you go out into the financial markets and you look at interest rates, in some cases, like if you go to a bank, they're actually structured reasonably well for you to understand them. So like if you look at the term deposit rates, they're structured by time, and similarly, if you want a loan, they're also structured by time. But often the interest rate markets are separate. Like if you go and try to look up government bond yields, you'll find that that information is in a different place than the corporate bond yields. And when you look at the structure of the data presented to you, say, particularly in the corporate bond, it's simply there in alphabetical order. And it's not a particularly convenient form for us to understand any structure that may be there in that data. And so what we do in this topic is we start to look at some of the, in one sense, we're still pulling an interest rate apart and seeing what goes into it. And so there's a number of things that goes into the building of an interest rate that we want to look at, and that will hopefully help us to interpret the structure of interest rates that we may see in the market. We may just have to adjust the form of the data so it actually looks reasonably sensible to us. So this is an outline. We'll talk about the term structure itself and the yield curves. Yield curve is simply a graphical representation of the term structure. And then we'll talk about 4 theories of these interest rate levels. The expectation theory, which is the main one. And then there's these 3 others. Liquidity premium theory, which is actually around a particular risk. And then the market segmentation and inferred habitat theories are just slightly different variants of this, basically the same thing. And then in the final section, we'll talk about various risk factors, because every time we strike a risk factor, what we have to do is work out how much it's likely to cost us in terms of the life of the investment, and then we'll have to ask that as a risk premium into interest rates. So first up is we're going to look at this thing we call the term structure, and also the things we call yield curves. So what's a yield curve? What is a yield curve? Anybody met a yield curve? Widely used in the financial industry. Lots of people use them. for all sorts of things. Anyone actually met one? No, nobody met one. I'll show you some. Here's a. So here's this thing here. I'll show you what it is. Way down the bottom here. Says here, Investment Committee Monthly Review. This is actually from last year, October 2016, so it's reasonably recent. And there's a long report that comes from the Investment Committee. But here they have a set of what we call yield curves, which is basically a graphical representation of what we call the term structure. And this particular set of data here, this was the most recent yield curve. That one was 4 months previously, and this one was the year before. And so in the commentary, which is up here and goes on down here and over the page, is basically discussing the implications of this particular yield curve and how it has changed, both, in this case, when you look at them, in one sense, the shape of that has not changed much, but certainly the level of it has. And when people look at yield curves, they look at both the level of the yield curve and its shape, and particularly what they're interested in when they're looking at the financial analyst is how this thing has changed over time, particularly around the shape, but also the level. And there are various ways of trying to interpret what this thing might mean. If you're working in the financial sector. So a yield curve, I might put it. A yield curve, when you think about what you're going to have, if you go out to get market data, you have a time to maturity, and you collect a whole bunch of data on bonds, and you get a bunch of yields for each one of them. Now, you'll have a whole bunch of data in your table, but when you have a table of data, it's often quite difficult to see any structure that might be there. And so often the best thing to do is simply to plot that up on a graph. And so, you would plot it up here. So this would be your yield for your bonds. And then this would be time to maturity here, along with it. So you get a bunch of data points, maybe scattered like that. And then you simply connect them up. And that would give you what we would call a yield curve. And it simply shows you how the yield changes with time to maturity. Now, one of the important things about that is that, where's my line? Let me see if it can work. Hang on. Okay, the real key to making a good yield curve is that they differ only in the length of time to maturity. Now, often in practice, that's actually really hard to achieve. And so what people tend to do is simply take the most recently issued government bonds. And so if you look at a number of countries that issue, governments will issue bonds out to 30 years, there'll be a whole bunch of them on issue that have been issued over a long period of time, and they simply take the most recently issued bond for any particular period, and that becomes the data that goes into the yield curve. So if this was indeed 30 years out here, and then that interest rate there would simply be the interest rate on the most recently issued 30-year government bond. So that's basically how they do it. Because what we want is we want the other factors that might go into the yield curve, or the interest rates, and we'll talk about some of these, these various risk factors. We want them to basically have all the risk factor stuff exactly the same. So the only thing that really matters in drawing it up is the time to maturity, because that's the thing we're interested in. How does the yield vary with time to maturity? That's the real key thing that we're after. So that's what a yield curve is. Now you've seen one. Did anyone come across there's several different types, very common ones. Well, some are more common than others. But anyone come across any type of yield curve? What would that one be called? An ascending one. Yeah. What did you say? Ascending. Yeah, that one would be called ascending, essentially because as the time to maturity goes up, the interest rate goes up. So any other ones you may have come across? I mean, the three I just showed you out of that report were all basically ascending ones. Yeah, go ahead. Well, the longer-term bonds would be way out here. You know, if this was a 30-year bond out here, you're looking at, you know, longer-term bonds be out there. How do you mean they're not constant? Okay. All right. Okay. So in terms of their basic shapes, this one would be called an ascending, yield curve. And it is by far the most common one you'll see out in the markets. And those three that I showed you from that report, they were all basically ascending. The other two common ones, well, they're not as common, but another one is that you can get ones that are basically running down like that. And that would be called a descending, because basically in that one, as the time to maturity goes up, the interest rates go down. Not as common as the ascending, but we certainly do see them. Another one would be, where basically interest rates are all approximately the same, and we would call something like that a flat yield curve. And so when people are looking at these things, within the financial sector, they look at them trying to extract some useful information for themselves and their clients about what will happen in the future. So the actual shape of these things is instructive about trying to understand what the future is likely to hold. Because all investing is about looking into the future, making forecasts, and then acting upon the forecasts that you make. Okay. So there's a forward drawn very nicely. This one here is not in the textbook. It's often considered to be a descending yield curve, because often you don't get a pure descending one. You usually get this little rise on the front, and then it'll drop away. But sometimes that's actually considered a separate one on its own, the humped yield curve. Okay. Any questions on those before we move to try to actually figure out what this stuff might mean? Yeah, go ahead.
I'm just wondering that you said that the 30 years, you said you drew the graph. The 30 years is the end of, so it's the new issued treasury bonds. So what about the rest ones? The rest ones is just the previous released bonds.
Well, what they do is if you take the Australian government as an example, what they do, they undertake to issue a huge range of bonds with all sorts of maturities ranging from, I think their shortest is 1 month, and they actually call that a treasury bill, through to 30 years. So they're not issuing everything at 30 years. They're issuing things at 5 years, at 10 years, at 15 years, and so on. And so when you go to construct your yield curve, there will be a lot of things that were originally 30-year bonds on issue out there, but you simply take the most recent 30-year bonds for your data point. Now, when you come into the 15-year bonds, there may be 30-year bonds with only 15 years left, but you don't use those. You use the most recently issued 15-year bond. Okay, so that has a 15-year maturity, and you get the most recent one. And when you come down to the 10-year, of course, there may be other things like things that were 15-year bonds that have 10 years left. You don't use those. You take the most recently issued 10-year bond to go into your data.
So which means all those data actually don't from one time point. They might from different time periods issued. Just the most you just use the most recent data.
Yeah, you take the most recent data, and for example, in Australia, they've undertaken these things like a 30-year bond. They don't do very often, but they have undertaken that they will do a 30-year bond every year. Okay, so basically, that data will get a little bit old, but it won't get really stale. Okay, and something like more shorter, like 5-year bonds, they'll issue them on a fairly regular basis. So if you go to get that one, you may find it's only like 2 months old. And so, yeah, there is an issue with them getting a little bit stale, but they issue them on with sufficient regularity that even though they may be a little bit stale, they're pretty good.
Also, sorry.
Oh, yeah, go ahead.
Since you said because they just broad, you just link them together, so which means that they discrete data to that.
Yes, they are. And there's no doubt about that. Yeah.
So there's no point that you just link them together. So there's no point in the line between them, because then the discrete data, you link them together. There's not a continuous.
Yeah, they're not continuous, but I mean, say when you're thinking about like particular long end, you know, they may be issuing a 25-year bond and a 30-year bond. You've actually got a gap in there. We've got no data. But if you need to have an interest rate somewhere in the middle, you would do some sort of interpolation between those 2 points to arrive at a reasonable interest rate. Okay. So the fact that they're discrete, I mean, that's simply a fact of the data. But if you need an interest rate in the middle there, you would simply interpolate between the 2 points, two most recent points.
Just kind of like build up a portfolio or something.
Well, not really building portfolios, building yield curves. Any other questions? Okay. So this next slide, this is actually in there twice. It's not a mistake that I've got it in there twice. So basically, when we look at this is basically tries to explain what on earth people are looking for, or thinking that they might extract from a yield curve. And so we'll look at it now, and we will come back to it again and have a second bite of this. So the basic idea is that, you know, time runs along in this direction here, and there's some business cycle that goes on. There are relatively long periods of expansion within an economy, and then there are periods where the economy slows down, may even go into recession. And the yield curves reflect basically where you are in that business cycle. So the way that they have drawn this thing here, they've drawn it very nicely in nice sine curves up here in this part of it here. But when the economy is really booming, so it's going really well, in one sense, it's actually expanding faster than it can sort of normally sustain over the long term, is in those circumstances, you find a demand for funds to go and invest, you know, say expanding, you know, plant and equipment, expanding businesses and so on, maybe even consumers because things are going well, they have jobs, you know, unemployment's very low, they might be looking for funds themselves. That there was a big demand for funds to be borrowed. And because short-term interest rates usually move around quicker than long-term rates, what we see is when the economy is booming is that the short-term rates come above the long-term rates. So this is the short-term here, and that's the long. And so when the economy is really going well and about to slow down, that's when we tend to see this descending yield curve. So if you see a descending yield curve, the financial or economic interpretation of a descending yield curve is that the economy is going to slow down. Maybe, depending on how you interpret data, it may even go into recession. But, you know, that's right now, things are going really well. But you're looking at the yield curve, trying to figure out what the future holds. And so you would say, the yield curve is going down like that. We're probably heading into a period of slow growth. We may even be heading into a period of, recession. Now, when it's passing between, you know, this point here is sort of like when it's come out of its peak and gone, and it's slowing down, or alternatively, it's over here, it's come out of some really slow period and it's starting to build up. It's at those points that you would get these flat yield curves. So a flat yield curve, you have to look into the past. If you come out of a period of really strong growth, yield curve is flat, your prediction is that you're going into recession. Conversely, if you're over here, the past, you were in a slow period of growth, yield curve is flat, you predict that the economy is going to pick up in speed. And this final one, when you're down here in the really slow period, again, because the short-term interest rates tend to be much more responsive to changes in demand than long-term ones, then that's when you see the upward sloping curve. And so what you would interpret that to mean is that the economy is likely to pick up speed in the months and years ahead. And because if you think expansions tend to go on for several years at a time, recessions tend to be a few months at a time, most of the time the yield curve is upward sloping. So if we look back at these ones here from our investment committee, they're looking at that, and what they're seeing is that, you know, that was a year ago, that was 4 months ago, this is today, is that, you know, the Reserve Bank has been dropping the cash rate. Other interest rates have been responding to that as very much as the Reserve Bank wishes. And ultimately, because it's upward sloping and the interest rate at the levels are down, they would forecast that in the future, the economy would expand and it would start to grow better than it is at the time that they write the report. Okay. Any question on that before we move on? Okay, everybody seems happy? So here's some real ones. This one up here from 2005. That's in one sense that's really remarkably flat because it goes out 12 years, and pretty much every interest rate is around 5.5% from a few months through to 12 years. That's quite remarkably flat. This one here obviously is an ascending one, or sorry, ascending. So as time to maturity goes up, interest rate goes up. Now this other one here, a little bit hard to say what that was, but I think the implication is because it goes down here, it's supposed to be a descending one. If we look at some New Zealand data, here's some New Zealand data. What's the problem with, before we actually go and plot this stuff up, what's the problem with this data? If we were actually going to make a yield curve, and this is the data we had, there's a problem with it. Can anyone spot the problem with this data before we go and actually plot it? Timeline? It only goes 10 years? Is that the point? 30 days? Well, you want short end, don't you? Yeah, so it's not time to maturity. Time to maturity is not the issue here. Bank bill versus government bonds, and what's the issue there? Well, yeah, absolutely right. Did you have an idea?
It says above longer maturities, they'll have a yield maturity, but it seems to be backwards. Because 30 days are higher than 10-year government bond.
Well, yeah, I mean, in terms of usually, I mean, that upward sloping curve is the normal thing. Okay, and this data here is pretty odd. But the thing that we have to take account of is your point, is that if we split them in two, these ones are bank bills up here, and they're private sector, so these ones have they have a default risk premium in here. These ones here are government bonds, and so if we were actually going to use this data, we do have to be aware that the private sector bank bills have a risk premium in there which the government bonds don't have. And that risk that we have in this particular case is the fact that it may default. Okay, very unlikely in terms of the banks, but again, it's not zero. So when we plot that, we get, it's actually this one, this is this one down here. You can see it's very strange. In fact, if we split them, there's your bank bills there, and there's you got from that point on is the government bonds, and we could scrub that out if we really want to. But when we see something like that, obviously these nice smooth curves that we've looked at so far, sometimes you don't get those, and we need some framework for thinking about what drives interest rates that might explain why we get these odd-looking yield curves, because you certainly do get some odd-looking ones at times. So we need to think about what drives interest rates and why that might end up with a very odd-looking yield curve. Okay, so any question on that before we go to the actual theories themselves? Okay, so we call these things theories, but these aren't theories like you get in physics. This isn't like the theory of gravitation. The theory of gravitation actually works. Now, these ones here, they're more like good ideas or maybe even frameworks for thinking about what drives interest rates. So we can't expect these things to work like the theory of gravitation, which we apply if we want to send a rocket off to Jupiter. We know exactly how to do that because the theory of gravitation works really well. With these ones here, at best we can do is use them to guide our thinking about interest rates. So there are 4 of them that we will look at. These isn't all there is, but these are the ones we're going to look at. The first one, the expectations one theory, which is the one we're going to take the most time over, is the one that's basically the start. If you can understand this one, then the other ones build on it in different ways. So that's our base. The liquidity premium theory is actually liquidity. It's actually about liquidity risk. So we're actually looking at our particular risk premium with the liquidity theory there. And then the market segmentation and preferred habitat theory are basically two variations on the same idea, basically saying that the market isn't a single market, but there's actually a bunch of markets in there, and we just piece them together when we draw up a yield curve. So those are the four theories we're going to be looked at. So anyone come across the expectation theories? Have any idea what this means? Yeah, go ahead.
Would it maybe just be kind of like based on like how spirals work? So like the future is influenced by how people think that it's going to happen, so they drive it a bit.
Okay, so how do I say it? Yeah. So basically, what you think the future holds influences you today. Is that the point?
Ends up driving in that direction based on how you act.
Okay, and your idea is that it's also self-fulfilling, like a self-fulfilling prophecy.
Yes.
Yeah. Okay. So yeah, that's basically the idea. Is that if you look into the future, and you're making forecasts about the future, then you can actually use those to explain the interest rates you see today. So expectations that you have today about the future you can use those to work out what interest rates should be. So basic idea is that if you take the two common ones, the ascending and the descending, if this yield curve is sloped upwards, that's the ascending one, then the idea is that implies to us that people think that the interest rates will rise in the future. That's the implication. Now, exactly how they do that, we'll do some calculations to show that. The other one, the descending one, is the opposite. If you see a descending curve, what that implies is that the interest rates in the future are going to go down. And if you think about how we interpret the economy, descending one, is that you expect the economy to pick up in speed, grow faster in the future, and then you would also expect demand for funds to go up, and that would drive up interest rates. Conversely, if you see it going down, our prediction was that would send us into a recession. The demand for funds would drop off, and of course, that would send the interest rates down. So let's think about how this might work. So I'll start off with a new bit of paper here. Grab my pen. Okay, so we've got this situation. So we've got this very simple world where there's only two investments. There's a 1-year investment and a 2-year investment, and both of them yield 6%. So if we think about what happens in that in terms of investment, so up here is dollars, along here is time. There's 1 year and there's 2 years. We have two investment paths into the future. We can either buy a 1-year bond now, and then at the end of that year you buy another, or you can buy the 2-year one now. So if you think about what happened if you buy, a bond now, so per unit of dollars, per dollar, you can get 6% for that for over the year, and that will take you up to $1.06 after 1 year. If you're going down that path, you would then simply take your $1.06 per dollar invested, and you go out and you buy another batch of bonds, and that would take you up at 6% there to $1.1236.36. So the thing with these ones is that this one here, that's observable in the sense that you can go out into the market and you can actually see that interest rate today, and so you can actually buy a bond today with a 6% yield. Now, in terms of what we've said about it, this one over here, that one there, that's an expected yield. So we've made our forecast. However we make our forecast, And we have forecasted that in a year's time, the interest rate is still going to be 6%, and so our expectation is that we're going to invest at 6%. That's what we expect to happen. And so that means at this point here, this is actually an expected payoff because it involves one that we can actually see, that we can actually get today, plus a forecast interest rate. So this $12.36, this is something that we expect to happen if we follow this path. Now, if we take the other path, and the other path is that you have a 2-year bond with 6% compounded annually, you would actually travel along the same path here, but I'll draw it separately. So this one here, you would go at 6%, and again, this one, you can actually get this today, so this is observable, and you would end up in exactly the same place. $1.12.36 at the end of the investment for every dollar invested. So the basic principle that we're going to apply here is if we have 2 or more paths to the same destination in the future, we want to arrive at the same place. Okay? So what we want with these interest rates to be such that it doesn't matter which of those paths you take to your future, you will arrive at the same place. That's the basic idea that we're going to use when we use this theory. Okay, questions to this point? Okay, all right, people are happy. So, now where's my next one? So what we're going to do now is what happens if the expectation is that it's going to rise. So grab another bit of paper. So here's the dollars up here. Here's time along here. And there's 1, there's 2. And so the 1-year interest rate hasn't changed. So it's still at 6%. And so we would start off here with $1. We'd invest it at 6%. And we end at this point here with $1.06. Now, looking into our forecast, however we make that forecast, what we see is in a year's time, we're going to be able to get 12% on this bond. Okay, when we come to got $1.06 out at the end, we're going to be able to put that on a new bond, and we're going to get 12%. So this one's going to go zooming up here at 12%, and again, this one here is forecast, and we'll end up at $1.18.36. And again, because we can't get that today, we have to actually wait to this point. This is what we project to get. Okay? Now, if the 2-year bond hasn't moved, and it's still at 6%, then you would simply trundle out here with your 6% bond, and you would end up at the $1.12.36. Hang on, that's not 30, that should be 72. I think this one's 72. 72, I think. This one's 36. Okay, so if you think about the fact that we have two paths into the future, okay, one of them is definitely worth more than the other, okay? The 2 6%, we can see that in the market today. We could buy either of those bonds, but we're looking into the future, and we forecast we're going to get 12%, and based on our forecast, it's very clear that buying the 1-year bond now and then rolling that over into a second 1-year bond is going to make us better off than if we bought that 2-year bond now. So the question is, if this was your genuine belief, so you actually made these forecasts and you thought this would really happen, what would you do with the 1-year bonds? What would investors in general do with those 1-year bonds? Buy more, okay? So obviously, although there's still 6% bonds, that actually gives you the better path. So, People, there's buying pressure. So what happens to the price? Price goes up. And what happens to the yield? Yield falls. And what about the 2-year bonds? What happens to those? What do the investors do with them? Sell them, because they're obviously not a good path. Sell, so what happens to the price? Price fall. And what happens to the yield? Yield rises. So what we think will happen on the basis of the theory is, because we expect interest rates to rise in the future, people will act on that, and then the interest rates will adjust themselves slowly or quickly, as the case may be, but ultimately they'll come back to the point where this 1 year followed by that one will arrive at the same point as this one. So that's the basic idea. Now, if this is 12%, like we thought it was, say 12%, this is our future one here, and let's say, for example, the 1-year bond went down to 4%, then at this point you would have $1.04, and then this one would end up here in our terms of expectations, $1.1648, I think that's about right. And then we can actually work out what this interest rate here should be. Okay, this interest rate here, we just need something that will compound us out to there, and it's approximately, I'll make it blue, about 7.93%, or if you round it up, 8% if you really make it nice and round. So the idea is that, if you think of what's happened here, is we started off with essentially with a flat yield curve. I think I've got a nice flat yield curve over here. Yes, I had a nice flat yield curve here. So everything was nicely flat here, 6%. And that's what we had. The 1 year and the 2 year were 6%. But because of our expectation that the interest rates would be much more favorable in the future, people traded in the market, sold the things that was less valuable, bought the things that were more valuable. That brought things back into nice path here, so that they're exactly the same. And what we have is that the short-term one dropped down to 4%, and the longer one, the 2-year one, went up to about 8%. And so you can see we went from a flat yield curve to an upward sloping yield curve, because we expected the interest rates to rise in the future. Okay. Anyone want to ask any questions on that or make any comments? Yeah, go ahead.
Sorry, I'm just wondering that I've been told that the bond actually is not that liquid, so they don't sell much. And how long for this kind of to reach the equilibrium?
Okay, well, these are practical issues in real life. It's that, yeah, if the bonds aren't very liquid, I mean, trading them is hard. But we're assuming that we've got a nice market and we can trade them at any volume we want. So we're just assuming that the market will behave in a manner that suits us. So if we want to sell them, we can. In real life, that's actually can be a bit tough. But that's the basic idea, that if you see a pathway, when we started at the top there, there's definitely a pathway that is more valuable than the other. You want to buy that. And in terms of the argument that we're making, we just assume that we can. And there's one there that's not worth as much. And if you have those, you want to sell them. And in terms of the argument we're making, we just assume that we can. Okay. In real life, you might have problems, but we just assume you can. Okay. Any other questions? Okay. So we can interpret these things. Okay. So when you're thinking about interpreting them, you can actually interpret them in both directions. So if you think about, if the market expects interest rates to rise, then that would generate an upward sloping yield curve. Okay? So if you expect that's what's going to happen, then people will trade in such a manner that it would generate an upward sloping yield curve. The other way you can do it is you can actually start with a yield curve and ask, well, what do people expect to happen? And so in that case, if you see an upward sloping one, you think, everybody out there thinks that interest rates are going to rise. And if you see a downward one, you would interpret it as the market expecting the interest rates to decline. Or so you can do it the other way around. If you expect interest rates to decline, then you would expect to see a descending yield curve. And of course, if things stay exactly the same, then you expect to be flat. And you can interpret it both ways. One is you can generate from your expectations a yield curve, or you can look at a real yield curve and pull out of that other people's expectations. So it's widely used, very widely used. Every time you see a financial market report of some sort in detail, it's quite common to see some sort of yield curve analysis in there, just like we saw from Craig's and Partners here in their monthly investment report. It's not uncommon to see a yield curve analysis because of the information that they can extract from it in terms of what other people expect. So if you're an investor and trying to outsmart the market, you look at the market, see what the market thinks, compare that with what you think, and then you make your investments based on where you differ from the market consensus. But they're very widely used in the markets for people. Okay. Any questions on that to this point? Okay. Okay, so in terms of the interest rates, there's two types we've been talking about. Let's clarify exactly what we're talking about here. So when we talk about a spot rate, what are we talking about? When we say a spot rate, what are we talking about? What's a spot rate? You're not sure? Okay. Yeah, go ahead. Yeah. So if you're talking about spot rate, that is when you can go out in the market and you can actually see that thing today and get it from the market. So what's the implied forward rate? Well, it is in one sense, but you don't make the forecast yourself. You actually use the market data to work out what the other people think it is. Okay? I mean, it is an interest rate that will lie in the future, but instead of making a forecast yourself what it might be, you're actually going to use the market data, you're going to use the spot rates, to work out what other people think the future rate will be. So that's why we call it implied, because actually it's calculated from real data. So it's what being implied by the real data, and it's a forward rate because it's sometime in the future. It's not today. Okay. Any questions, comments? Okay. So here's a little bit of notation. If we denote it by an R, that's an actual real observable spot rate. Usually they put a little thing in front of it to say when it applies from. Typically, if we're dealing with spot rates, it's from time zero, and then the N is how many periods it applies for. So like for the 2-year ones, they would be a 0 R2 rate when we're talking about them. Now, the implied forward rates, again, it's using F, basically forward, and again, it starts at some time t in the future, and the one we were working with would be a 1F1 because it's a rate that applies from 1 year from now and applies for 1 year. But because you can have it for any length of time that you can get the data for. So these ones, they're in the market. You can go and actually find those. These ones here, we will calculate. And they are implied by the data. So the data implies these in a very clear manner. So when we're thinking about how we're going to calculate these things, So here's a basic empty graph at the moment. We've got 4 periods. They're only 30-day periods. And we can go out into the market, and a 0R1 interest rate is simply an interest rate that we can see in the market today. It applies for a 30-day investment. So that would be a 0R1, and that's a real live one. We can actually find that today. Similarly, 0R2 would be a 60-day investment, and that would apply. You could actually go out and make that investment today. When we go into the future, okay, so this one here, a 1F1, is an interest rate that applies 30 days from now for a 130-day period. So this one here, is one period in the future, and it goes for 1 period. So that is the interest rate that we expect to apply in 30 days from now for 30-day security. Now, obviously, we cannot see that, but we can calculate it as long as we've got a 0R1 and a 0R2. We can actually calculate what that should be. We can go further out in the future. That one there starts 30 days from now and runs for 60 days, which is 2 periods. That one there applies 2 periods in the future. That's 60 days in the future, and it runs for 1 period, or in this case, 30 days. And we can continue on building up into the future. So that one there is 60 days from now, and it runs for 60 days. So there's 2 periods in the future, and it runs for 2 periods. And basically, if you can get enough of these ones here, these real ones, you can calculate all sorts of ones. You can calculate what other people think the interest rates will be in the future based on what you can actually see in the market today. So anyone come across the term structure formula? Anyone actually met it in another course? No one met it? Okay. Well, all right. It looks a little bit messy, but it's actually, the idea is not that hard. So the basic idea is that this interest rate, which is one you can see in the market today, is simply built up of a whole bunch of short-term ones. So this one here is a long-term, and these ones here, you can see they all got ones. So these are all short-term rates. So if you think about when we just had the 2, and what we said is that if you have 2 or more investment pathways into the future, you want to arrive at the same destination. And so this is what this thing is doing. Instead of having just 2 periods and only 2 pathways, as the number of pathways goes up, we still want, independent of which pathway you take, to arrive at the same destination in terms of your dollars at the end. And so what we're saying is that the long-term interest rates are simply averages of the short-term rates. So if, say, that was a year, and the one was, say, 1 month, we could work out what the annual interest rate would be based on 12 1-month interest rates. So the first one we could actually see. We could actually go out in the market and see that. And we could forecast the other 11 of them. And with 1 real one and 11 forecasts, we could actually work out what the 1-year rate should be. And of course, you can expand that to any length of time period you want. So basically, long-term interest rates are simply averages of short-term ones. Okay. So we'll start at this point next time, because we're basically run out of time, with this example. So we'll start on this example at next point. If you want to ask any questions, be around for a while. Otherwise, we'll see you tomorrow, and we'll start with this example here.
to be held?
When?
Yeah.
It's not this Thursday, but Thursday after.
Oh, okay.
Yeah, it's on the course information system already.
Okay, sure. Because I haven't heard anything of it.
Oh. Start off a nice flat line, and then you end up in a nice upward sloping curve, because what we expected to happen in the future changed. And so if other people believe the same thing, trade with the market, and that would have changed the shape of the yield curve because what we believe about the future has changed. Hello.
When did you say that?
It's next Thursday, not this one, it's one after.
Next Thursday.
Next Thursday, yeah, next Thursday.
During class time?
No, it's in the evening. The stuff's on the course information system. It has been there since before the start of the
I printed out my course outline and just checked.
Well, it's not on the course outline. I'll show you where it is.
Sorry. What was I planning under?
Thank you. There it is.